Welcome back to Vantage, and we're starting a new series. In turbulent times, I've got an investment veteran on the show. He's going to reflect on the environment we are heading into. He's a little bit bearish on equities, but he's also suggesting how you might invest in the current climate. Let's go and take a look. Okay, welcome back to Vantage. Delighted to have Steve Russell here with us from Ruffer. Ruffer, if you don't know it, is a large UK institutional investor with a remit to invest internationally across a range of different asset classes. It's great to kick off this new season just at a time when I think everyone is wondering where the world is going. Steve, welcome to the show.
Thank you.
Before we get into the world we're in today, maybe just chart your own journey in terms of where you came from and how you ended up at Ruffer.
Yeah, I mean, that's quite interesting because I was just talking yesterday with my teenage son and daughter about exactly that. And they were saying they didn't have a clue what they wanted to do.
Mm-hmm.
And I was reminding them that when I was their age and they're 17, coming on 18, that I didn't have a clue either. But I went to college, studied economics, and was lucky enough to come out of university in the middle of Big Bang, just before 1986, 87. So everybody wanted to go to the city. So I just followed suit, didn't know what on earth the city was or what I wanted to do there. Went for lots of jobs, and in the end, in retrospect, got very lucky by getting a job as a trainee equity analyst. And that really set me on my way. I found that my love of companies, and then from there I moved on to be a fund manager, moved on to be a strategist at HSBC, which gave me the sort of top-down macro views. And then almost 20 years ago, I stumbled across a small company called Ruffer, run by Jonathan Ruffer. Loved what they did, and joined them as head of research, then took over running some of the funds, and it seems to work because I've been there ever since.
And well, Ruffer, from memory, was around 2004. It was sort of set up. Give me a little bit of a picture of, once you're inside Ruffer, what you find, the team, the kind of funds they manage, the approach.
Yeah, I mean, the key things about us is we only do one thing. It is a single strategy spread across a range of different, what you might call, outlets or products. So the Ruffer Investment Company is one expression of that, but it's a single strategy. And that's very much driven by a top-down view on the world that really starts with Henry Maxey and Jonathan Ruffer, who set our strategic direction. And then myself and the other senior fund managers join with them. Actually, every Monday morning we have a meeting, discuss where we're going, what's happening, etc. And that really decides the whole structure of all our portfolios, be they the investment company, be they unit trusts or OICs or SICAVs or segregated pension funds. It's a very interesting company to work for, very unusual, quite cerebral without being taking ourselves too seriously. It's the most challenging company I've ever worked for. And I end up finding myself in the company of people who are visibly more intelligent and more experienced than me. So my 20, 30 years of experience tends to be just a sideline to the business, but that makes it fascinating. It's quite a family type business, a collegiate business. It's grown up to be quite big now with about 26 billion assets under management. But I joined when we had about 500 million. And it was a really tight-knit team. So, it's an interesting place to work. And because we're multi-asset, top-down driven, but also delving down into individual investments, companies, etc., stocks and shares, then you get to cover pretty much everything. The other thing, I suppose, I'd say, is the way we think and the way we invest is very much informed, and this is part of Jonathan Ruffer's DNA that he's passed on to us, by a sense of history in economics and in markets. Jonathan is forever sort of recounting some Austro-Hungarian economic blow-up in the 17th or 18th century that most of us have no idea about. But it does enable us to get a better, not necessarily better, but a solid view and a secure foothold on where we are, especially in times like today when things look like it's unprecedented, but actually things have been similar in the past.
Yeah, I would have loved to have been a fly on the wall view of post the in your Monday morning meeting post the mini budget.
Yep.
I'd love to. I mean, we're in very turbulent times. The volatility of the market is extraordinary. Would love to get a view of your world today in light of the rising rate, rising inflationary environment, and to a certain extent the political meddling that seems to have sort of complicated life as well.
Yeah, where's the best place to start? I suppose the first place to start is to be honest. We at Ruffer had been predicting that inflation would return and would be a problem. The only problem with that was we predicted it just over a decade ago, and so have sounded a little like a stale record or stuck record with that view. But it has long been our view post the crisis in 2008 and the build-up of debts and the bailout of the financial system, the inflation and inflating away the debts would be the only way out.
Yeah.
What we didn't know was it would take over a decade to occur, but we've been patient. And what we see ourselves in now, if I take a sort of top-down view, is we're in the transition period between an old regime of low interest rates, low inflation, or in fact falling inflation and falling interest rates, which meant that you had a perfect Goldilocks environment for financial assets. And we've been through a period between 20 years and 40 years of monetary dominance over fiscal. And it's been just great for equities, great for bonds, and as my younger colleagues keep reminding me, that golden period for investing and stock markets has encompassed pretty much all of my career. Yeah. So it's quite a lucky place to be. We always knew it would come to an end. We were never certain exactly when, but we were certain it would be inflation that would be the trigger. And we now find ourselves, at least in our view, transitioning into a period which we think will be prolonged, 5-10 years minimum, of higher inflation, higher interest rates, high inflation volatility, and fiscal dominance over monetary. And what that means is, irrespective of what Liz Truss tried to do and now is not doing, and it looks like the bond vigilantes have just won the war against the UK government, we expect to see interest rates held higher than they should be for a prolonged period of time, inflation above target pretty much constantly for the next 5-10 years, central banks sidelined to some degree, and a much less friendly environment for financial assets after a fantastic couple of decades. What we see today is the really difficult transition between one very benign regime and another less benign regime, though in both regimes there will be opportunities to make money. But transitioning from a low inflation, low interest rate regime to a high and unstable inflation and interest rate regime is always going to be difficult. And what we see is the markets struggling to comprehend what we think is happening. So they can see interest rates rising, and so they fear the impacts of that. They can see that there might be a recession coming, they fear the impacts of that, but they're still hanging on to the old orthodoxy of long-term growth stocks are the place to be. The discount rate will eventually come back down again. Inflation will return to where the central banks think it is going to be. And we think all of that still has to change. So we're always cautious. That's our sort of stock in trade. And we remain super cautious in the short term at the moment.
Okay, but to pick up on that, I mean, given your view, how are you positioning yourself on a relative basis between, say, equities, gold, other hedges, and the bond side?
Yeah, I mean, quite strange, especially for me, but for most of the people at Ruffer. We do multi-asset and we are very much top-down and sort of macro-driven. But at heart, we've all been or are equity people. So to sit here today with what is our lowest ever equity weighting of about 15%, and that's across global equities, is quite a strange feeling and leaves you a little disconnected with equity markets compared to usual. I mean, we have been very low in the past. We're down at sort of 20% in the period running up to the financial crisis in 2007, going to 2008. But technically, I think this is the lowest. And the reason for that is that we think there is further downside in stock markets, most obviously in the S&P 500 or the NASDAQ, basically, where we've seen the bubble burst in the profitless tech, but not really yet in the profitable tech. And these are great companies, but we don't think they're worth the valuations they're ascribed to. So we still think there's further downside. And then the key driver of being sort of super short term cautious on equities is that we're very worried about a liquidation event in the stock market. What we can see is for the first time in well over a decade, there is an alternative. You know, that Tina phrase, there is no alternative, you have to buy equities because there's nothing else. Well, that's not true anymore. US cash or short-term bonds are likely to be yielding 3-4% pretty quickly. Not sure where the UK will be yielding. And that's difficult to get from banks, but you can certainly get it from money market funds, etc. So we see a real risk of a stampede out of liquid assets that have been the main driver of people's portfolios over the last decade or so. And those liquid assets, the pool of those liquid assets is getting smaller and smaller because in search of yield, investors have gone into private debt, private credit, private equity, and you can't sell those. So we're very worried that what's been a slow motion car crash in equity markets for the last year to date, and leading with most of the indices down 20-30%, could end up with a liquidation event focused on equities. And that's really something we want to take advantage of being on the other side of, rather than taking the journey down. That's made worse, I think, by the fact that central banks have essentially squeezed the main high street investment banks, global banks, in their ability to provide finance for asset managers. And so they're being squeezed on their sides of their balance sheets. And at the same time, they're having to provide borrowing and capital for the inflationary effects on working capital for ordinary businesses. And that's profitable business now because interest rates are at a decent level. So we don't think the investment bank buffers are there any longer. So it all goes down to the asset managers. And for us, we've always worried about leverage, but liquidity to us is now the big issue. And a liquidity unwind in an illiquid market is really what makes us very nervous over the super short term. At the same time, we can't help but notice what's happened in the UK over the last week or so. And also, despite being sort of arch inflationistas, I suppose, we can see that inflation will or even may have peaked. So whilst we're a bit dubious about the reality of a Fed pivot, it's not impossible that we could see some sort of rally between now and the year end. However, and this is a complete reversal of where we normally are, we think long duration bonds are a more attractive area for that rally than equities. Normally what we do, or the way that Ruffer works, is in its most simplistic but absolutely sort of straightforward approach over the last 20 years or so that I've been there and before my joining, is to build a portfolio made of what we call fear assets and greed assets. And if you always hold some fear assets and they're the right assets, then with luck, you'll be able to avoid losing money when times are bad. And normally, through most of history, the fear asset has been some sort of bond. and the greed asset has been equities. And we'll vary the amounts, but generally that is how the process works. As we've come through the last decade of near zero interest rates, we concluded that bonds were no longer going to be protective, and so moved more into alternative assets such as volatility, credit default swaps, options, derivatives, and those sort of areas. And they're the bulk of the protection, the fear assets that we have in the portfolio now. As of today, after, especially in the UK, the massive sell-off in long duration assets, especially index-linked bonds, we think some of these yields at the very long end, so 30, 40, 50-year duration, look too good to be true. And that's where we're focusing our greed now. Okay. So it's inverted.
Yeah.
It won't stay this way.
Yeah.
And one day we'll get back to equities. But right now we think long-dated UK index-linked bonds, which as of about a week ago, in the middle of the panic over the mini budget and the defined benefit scheme, LDI unwind, got to ridiculous low prices where we were buying. But we think that's probably the best way to play a temporary relief rally in markets, both bond markets and equity markets.
I'll come on to the fear and greed, but in terms of, let's focus on the equities because that's really where our audience is focused on. So you touched on a couple of things there which might pivot the view. One is that the Fed itself thinks that, okay, inflation is sort of peaked and we're going to change our stance. The other is the capitulation rally. The capitulation of the market. Valuations get to the point where you think actually it's worth participating. What signs, so if you're negative on equities right now and cautious about life, what are the signs that you'd be looking for changing your mind?
Yeah, I've been through a few cycles, and generally I take the view that the main market will halve. And if we take that as S&P or NASDAQ, that gives you roughly 20% downside from here. So that would be a trigger for us, and that would be a very likely outcome of some sort of liquidation event. The problem going forward will be that, in our view, you should never go back into the sort of poster child for the previous bull market.
Yeah.
So just as the banks after 2008 really didn't perform for decade, 2 decades, a long time, and the same thing happened to tech stocks pretty much, not quite so long drawn out, after the tech bubble burst in 2000, then we think going back into the FANGs, the NASDAQ stocks, the dominant companies of the last decade, too early will be a money-losing strategy. So for us, the best area to look is very much short duration equities. And by short duration, you end up meaning value, high cash flow yields, high dividend yields. Yeah. And that fundamentally makes sense, because if you've got a high interest burden, or high interest rates, and definitely high inflation, then stocks yielding 5, 6, maybe 10% free cash flows must be the place to go. The other thing that we think will be really interesting is, as we get more deglobalization, shorter supply chains, and the whole change of that global supply chain framework that was built up in the previous 20 years or so, then the companies that have high invested capex and basically heavy industry, dirty companies that can improve their environmental footprint and make the biggest contribution to improving climate change outcomes are likely to be the way. So we think it's almost the reverse. The previous decade, maybe 20 years, has been high intangible, low capex, low asset companies, Apple, and they've done fantastically well. We think a paper manufacturer or Bayer or something like UPM Kimberly, a highly invested, heavy industry, was more likely to be the beneficiaries of the regime we see in the future.
That's good. That's great, and it's really interesting. That at a time when capital is scarce or it costs more, those industries where there is this heavy base invested capital, the moat is higher, look to be an interesting place. And particularly if you believe that it's going to be tough to grow, you'll compound it, you're paying out dividends, you're generating high cash flows. That in itself leads to investment returns. I just wanted to come back to the fear and greed sort of point. So you've identified a range of different bubbles. I mean, I read some of your comments on SPACs. We also look at the sort of valuation in tech stocks and how that's adjusting. I mean, I guess there's no sort of definitive answer to this, but just want to get a sense of where you think we are in that sort of fear and greed cycle.
Yeah. Well, I'll say this with a caveat that we have a track record of being somewhat early on calling, especially the downtime, but eventually getting it right. For us, we're still very much in the fear part, hence the worries about a capitulation or liquidation event pulling down markets. We have definitely seen some of the most outrageous excesses of that Goldilocks zero interest rate period unwind. And as you said, the SPACs were just a perfect example.
Yeah.
I think the piece I wrote referred back to the South Sea bubble at the time, and it just looked identical to what had happened 400, 300 years ago. That's pretty much unwound now almost entirely. And I think the same madness that infected profitless tech, be it Peloton, Beyond Meat, all of those sort of companies that might be fine companies, but were worth a few £100 million, not billions. That's pretty much gone. As I said, we still fear that it's not so much a bubble in the profitable big tech, but they're just overvalued and will be a long-term drag on performance. Where I'd focus my concerns is in credit and private markets.
Yeah.
Everybody was forced broadly, or certainly institutional investors were forced, and to some degree private investors too, in order to find some income, some yield, some sort of carry, they ended up going into private assets where the illiquidity premium could be expressed through better sort of interest rates or better dividend yields than you'd get from government bonds or safe equities. We think that now is the sort of the Warren Buffett quote about when the tide goes out, you see who's not wearing trunks.
Yeah.
Well, we've seen the people who never had any trunks, as in SPACs and profitless tech. Now we'll see the people who lost their trunks, which is the private markets. But they're hiding in the shallows so they can't be seen naked. I don't think I want to go down this analogy much further. So what the problem with them is they have delayed price discovery. Everyone knows that. You find out that you've lost some money with these entities about a quarter to 2 quarters after the stock market has repriced itself. But the big problem is illiquidity. You take a small example, though it's been big in the news recently, the problems for defined benefit schemes in the UK recently are, of course, of their own making in terms of the need to find very fast collateral to cover their derivative positions that were basically just liability matching and inflation protecting them for the long term, but had never imagined that you'd see moves in government bond yields of the sort we did.
Yeah.
Now that was a problem and is a problem going forward, but it's probably just about been managed now. But the huge issue was that their pool of liquid assets that they could sell quickly to raise this collateral was very small, and it's mainly in equities. So these pension funds were left scrabbling around and will still be left scrabbling around trying to find the capital they need for their derivative positions because they've invested so much in private equity. So, and it's not just private equity, private credit even more so in my view, because sometimes that's basically some of the debts and credits that banks didn't want to get involved with.
Yeah.
So they may be high yield and there will be great opportunities in distressed debt, but these are the people who will become the distressed debt.
Okay. I mean, I think, let me draw some of this together in that you've touched on it, the areas that you're investing in, but I think it's worth sort of summarizing it. So, rougher total return is there to outpace inflation and not lose money. Quite challenging when you're printing double-digit inflation. So, summarize how you're doing it.
Yeah. So the first caveat I'll put in place is our first and foremost objective is not lose money.
Mm-hmm.
The second one is make a decent return, beating that of cash. And we never technically say and inflation, but obviously people would look to us to be some form of inflation protection. Despite predicting inflation, we never thought we'd get to the levels we have. 10% across the developed world, potentially. I mean, I think Netherlands printed 17%. This is a small Anglo-Saxon stroke Germanic, country that doesn't do inflation.
Yeah.
It's astounding. So we hadn't predicted that level, and we'd always caveated our sort of outlooks by saying, well, of course, if inflation is double digit, we think nobody will keep up with that. The best thing you'll do is try and preserve capital, and that'll be relatively good. But we're still trying to make that sort of return. And in the short term, we think the inflation protection, the way of index-linked bonds, both short-dated and long-dated, especially now they've repriced in the UK, and same in the US, look very attractive assets that can give you some toehold into making those sort of returns. Then at the same time, our equities this year have been, actually, I think they've delivered a positive return because we've had that focus on, as you described, the short duration, heavy capex, and definitely energy. Another key part of making money in the last 12 months. And then we aim to make money out of our protection assets. If the world is going to be difficult and inflation is high and asset values are falling, it's being on the opposite side of that can deliver a positive return. And that's where things like credit default swaps, etc., come in. But there's no real way around it. Making a near 10% return in this market looks difficult, if not, I won't go impossible, but difficult. Weirdly enough, over the last 3 years, we've been compounding at sort of 8% or so, and rather better than we did in the boom years of the back end of the last bull market. So we're sort of keeping up with inflation, but I can't see any chance of us delivering a 10% return this year. If we can get naught to small positive, we think we'll have done a good job. And the key thing is that it's about having all your capital still available when things start to look interesting again. As I said, right now we think that's in bonds, but there will come a time when equities are oversold and there's an immense value there. Happened in the 70s multiple times, and we just want to have all our capital there so we can reinvest at really cheap prices.
Okay. I want to focus you back. So you talked about your equities delivered a positive return. Just give us a run through the investment process you go through when you're picking the names that you're investing in. Maybe you can give us a couple of examples from the portfolio.
We start being Ruffer with a top-down view of the world, and that does dominate everything. At heart, whilst we're equity people, our job is more asset allocation. However, in a normal cycle, our equity allocation will be somewhere between 20 and 60% of the portfolio. And so getting good equity selection is absolutely key. And that's one of the reasons why, despite holding fewer assets in the portfolio all the time, we've been able to deliver the good returns even in the better times in markets and in bull markets. So if you take a top-down picture that Henry and Jonathan will sort of signpost and signal us to, we then effectively use the equity part of the portfolio to populate two buckets. The first one is the sort of stocks and companies that come out of that top-down view. And so back in the early noughties going into post-crisis and 2010, we absolutely owned the Unilevers, the Apples, the Fangs, etc., because you could see falling inflation, falling interest rates, therefore discount rates coming down, therefore growth stocks doing well. Microsoft was another one that we were absolutely in. We exited them a little early, but we're now glad we did because of our fear that those discount rates wouldn't keep going. Mm-hmm. But that was the top-down asset allocation view. Today, that top-down asset allocation view goes to those value stocks, the short duration stocks, and capital invested stocks. And the examples there, I'm probably just repeating them. So paper companies, UPM, Kimini. We like Bayer, the German agrochems and pharmaceuticals businesses. It's probably a long-term business in terms of it's not being managed at its best, shall we say, at the moment, and it has problems having bought Monsanto off the Americans a while ago, and as often happens, the Europeans come along, pay a huge price for what was the best agrochemical business in the world, only to find that it's not quite everything that it was supposed to be.
Yeah.
And they've been now sued to high heaven on various Monsanto products. But we think that gives you a cheap exposure into this ongoing problem we're going to have, partially because of Ukraine, in terms of agriculture, food, and those sort of basic inflations. So those would be examples of our top-down generated stocks. The other half of the equities is where it's perhaps more fun, and that's where the analysts are free to find out whatever they think is interesting. And that can cut completely across the top-down view. It won't be the dominant part of our equities. So during the period when we were avoiding and basically selling out of high-tech growth stocks and anything that looked expensive in that way, we did own Ocado, for example.
Yeah.
We bought into it about £2, sold out. Actually, this one, unusually, we didn't sell out ridiculously early. We probably sold out between £16 and £20. And I think it's now back to £4.
Yeah.
But we could see that there was a business here that was likely to actually grow really well. On the smaller stocks, Games Workshop has been one that we've been big fans of. Trevor Wild, our smaller companies fund manager, has backed that from, I think it was about £7 to £120.
Yeah.
We've cut back our positions, but that's probably going to be a stock selection that at the right price will come back into there. Another one might be an example such as Tesco or Amex. Maybe Amex is more interesting. Amex is one of our few sort of remaining US equities that we hold. We like the sort of long-term growth story, but it's also an example of where we can hold an equity that almost cuts completely across our view of the world. Amex will do well. Yes, it'll do well out of higher interest rates, and that's not bad, but essentially it's a bit of a growth stock. It's a cheap growth stock, but it's also a play on the US economy. And if the US economy goes into a deep recession, it probably won't do that well, and the global economy as well. But we've got other assets that will do well then.
Yeah.
What we're always looking for is what if we're wrong? And something that looks a decent business, not overvalued, and gives us upside if, at least in the short term, we turn out to be wrong about the US downturn or something like that. And Amex gives us that with a management that we're very happy with. So that's probably a nice example of how individual stock selection can go almost completely the opposite direction, but not totally the opposite direction to our top-down view.
It's great that you've got that honesty that, you know, we might not get it right. The final piece is, so there's a lot of investors who will never have, to a certain extent, like yourself, you've been in the sort of Goldilocks era. There's a lot of people who've never been in a recessionary or an inflationary environment. from an investing perspective. The many management teams are running the businesses that we're investing in today who may not have been. If you had to give them, a word of advice in terms of the things that they should be thinking about in the current period, what would that be?
Yeah, this one, actually, I spend quite a lot of time thinking about this and talking with colleagues, because I have some very, very talented colleagues who, up until a few months ago, had spent their entire career never seeing a UK rate rise.
Yeah.
And I've seen quite a lot. I remember I bought my first house back in 1992 and was actually sailing with some friends across the English Channel to France when Black Wednesday, or whichever one it was, happened. And interest rates went from 10, 12, 15 to 19 whilst I was in the English Channel. Fortunately, by the time we docked, they were back down again, because my friend and I had just taken out a huge mortgage on a flat in Fulham. And we were just about able to afford the shift from 10% to 15, which is what happened. So it's a very different world they're going to face. And I think lessons from history are really important. So just looking back at what happened in the 70s and 80s, I mean, one of the things I remember was back then, supermarkets were effectively